Hey, Jeff Carlisa here from 38 Special, and we're rocking it up right here with Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have back with us once again Jeffrey Small. He's president of Arbor Financial and author of Turning Financial Planning Right Side Up. Jeff, welcome back to Traders Nation. How are you today?
Hey, Kurt, I'm doing great. It's so great to be back again.
Yeah, always a pleasure, isn't it, Jeff? Hey, listen, second day in a row, look out below, man. I mean, what's going on out there? Stocks fell sharply again today, down 600 points at this point. Is it fears over the U.S.-China trade relations is what I'm kind of reading and hearing?
Well, there's no doubt that those are impacting the market, but what really freaked the market out this week was the partially inverted yield curve we had between the 5-year and the 10 years. The 5-year started paying more than the 10-year. And normally when we have some type of an inversion like that, we're looking at a recession within 6 months to 2 years,
sure, which
I suspect is going to happen much quicker. But that's what's really rattling the markets. If the yield curve is going to continue to flatten and potentially invert, the volatility will get worse.
Yeah, you know, I've been seeing a lot about that, and I know, and first thing that comes to my mind is our discussions we've had here on Traders Nation in regards to flattening of that yield curve. That's a big, big problem, right?
Well, it really is, because it disincentivizes banks to lend.
Yeah.
So if lending slows down, hence the economy loses momentum, because we're in a credit-based economy.
Yeah. Yeah, and I remember way back when, and listen, I'm telling you right now, my credit score is 800 plus, personal and business-wise, right? And I remember last time that they started restricting the credit and contracting it. For instance, well, I shouldn't probably mention them, but huge. I had like a $55,000 credit line, right? And you're like, well, you're into us for about $8,000 right now. Instantly, my limit was that until it was paid down. They restricted credit, very bad for business, and I was not a risk. Are we looking at that?
Well, we're not looking at that yet. They're actually lowering the barriers for credit, and they're giving people credit that probably shouldn't happen. So, just to keep the party going right now. So I think at some point, though, the yield curve is definitely going to impact what's happening in the markets. But more pointedly, Kurt, you know, we hit an asset high in October 1st. We had $100 trillion of household net worth in real estate and stocks. It turned out to be about 510% of nominal GDP as a percentage. And when you get, that's the highest in history we had. Okay, that's the highest.
Yeah.
The next highest was in 2008. We were at 490%. So we're now going to go through a reversion to the mean. Things are going to go back to the long-term averages and asset prices. Since World War II is about 320% of nominal GDP to household net worth as a percentage.
Okay.
And so we're on our way back to that point again.
Okay, so reversion to the mean. If folks don't understand what that is, briefly, what would that be?
Well, going back to the mean is averages, and a reversion means we're reversing.
Yeah.
And so we're going back to the long-term averages of what asset prices should be. And otherwise, asset prices in real estate and stocks are too high, so they have to go back to the long-term averages. And so we're going to see a 30 to 35% drop in the markets. That's going to be a very slow and steady decline over a period of time. We're in a very 2000 market where the market dropped 10% only in that year, but there was still lots of volatility. That's kind of the market that we're in right now.
All right, so does that mean the slow and steady house of pain, or does that mean slow and steady we can readjust our portfolios and get to a flight of quality?
It's going to be a slow and steady house of pain.
Okay.
And I hate to say it, I'm not a perma there. I would love to say the markets are going to explode from here.
Sure.
But you know, we hit the second highest valuation in history on the CAPE index, and the reality is markets really can't get any higher based on the metrics that we have today. The demand is just not going to be there. And besides that, Kurt, the global markets are in the tank, man. I mean, if you look at what's happening in the global markets, if you go to Google and Google global stock market performance 2018, it's negative. Every market's negative for the year. For the year.
So is the United States market, is this a trailing trend? Are we trailing behind these global markets, or are we just unique away from them and we just got our own issues right now?
We're really the bright shining lights and as far as the global markets go. And so I don't know if the global markets will be enough of a contagion to pull us down.
Okay.
We have our own issues here.
Yeah.
But yes, we are gonna go backwards from here.
All right,
we're not going up.
I want to talk briefly last night. At one point, the futures trading on the CME halted over a sudden plunge. It's all over the news this morning here today. It's being reported that it's arrest of Huawei's CFO arrest in Canada, which I guess the United States has this arrest warrant out for the CFO of this company, telecom company. Again, I'm getting back to the geopolitical part of concerns that are out there. Is it just speculation at this point in regards to U.S.-China relations?
They punted for 90 days to try and come up with an approach that's fair on trade. And China is predatory. They shouldn't be taxing everything that they import from us. They marginalize our ability to access their markets, and they steal our technology. Yeah. And so we have to take a very strong stance towards China. I agree with that position, but it's going to cause some growing pains in the global markets. Right. And China's going to take a long haul approach, Kurt. They're going to wait Trump out. They're not going to give him any concessions. This trade dance is going to last for the next couple of years. It's not going away.
Yeah, I think, and with the deals that President Trump has done in his lifetime, okay, not just talking recently, I'm talking lifetime. He's a deal maker. This guy is, okay, and very smart. And I think he's going to negotiate, if possible, with China. Probably the best deal that we can even squeeze out of China, if successful. Your thoughts?
Well, I'm all for that. But, if you look at the report today, we hit a record 10-year high on trade deficits.
Right.
The trade deficit rose $15.5 billion in October, which is the highest since 2008. So, the intention is well and good, and, rebuilding America and putting America first is all well and good. Yeah. But that's not what's happening. That's not what's going on in the real world right now. We're importing more than we're exporting at a record pace.
All right. So hopefully we can fix that, because I haven't seen anybody been able to do that, and it's still not to be proven yet. Okay, with as much volatility that we have out there in the market, should folks be looking at or considering? I know they always should be, Jeff, considering readjusting their portfolio, maybe even a tightening up. But is there anything that folks should be doing right now? Is this just a flare, a friendly reminder that they should be tightening their portfolio up?
Well, there's no doubt that there's going to be a flight to safety here. It's occurring. The reason why we see so much volatility in the market is because a lot of investors are panicking and liquidating, and they're getting out because they have, post-traumatic stock market drop syndrome from 2008 and 2003. So, people should not have any risk right now. If you're going to live off of your earnings in the next 5 years of your portfolio, you should have zero risk today, zero. But if you're going to accumulate for the next 10 or 15 years, then you can ride it out. Right. And so it really depends on what your situation is, Kurt.
So it boils down to you should already have a plan in place. And if you have that plan in place, you should be protected by all this volatility that's going on right now. And if you don't have a plan in place and you're affected by this volatility, that's the reasoning why, right?
Well, that's correct. And so it's very interesting that Powell, the president, the chairman of the Fed, came out and said, we think that we're close to neutral now on rates. And so, if rates aren't going to go up anymore, fixed income is going to look really attractive again, because if rates have peaked, we're going to zero on interest rates by 27 to 36 months, because the federal debt service doubles with just one more rate increase. We ain't got the money. We're out. Yeah. We're broke.
How do you think 2018 is going to end? It's not that far away, but how do you think?
Well, I think we're going to be negative for the year. I think the volatility is going to continue. The jobs number just came out on ADP. We're at 178,000 last month. That's not a screaming economy, even though everybody has demands for employment. They can't find people to work that are qualified.
Yeah. Is that going to go into 2019, your thoughts?
I think 2019 will be also a negative year of 10 to 15% if the yield curve continues to flatten and or invert. So investors want to watch if short-term rates are going to start paying more interest than long-term rates. And that is always indicative the last 13 times of a recession. We've had 10 out of 13 times a recession within 6 months to 2 years. Yeah. And I think we're kind of running out of gas, Kurt, on this Trump optimism a little bit as far as the economy goes.
We're out of time. Where can we find you?
Go to arbor-financial.com, and they can follow me on Twitter and also LinkedIn.
Always a pleasure. Jeffrey Small, president of Arbor Financial. Head on over to his website today. Stay tuned. We'll be right back. Welcome back. You are tuned into Traders Nation. Don, I gotta let people know that interview. Okay, if you missed that last block, that last paragraph of comment from Jeff, you've got to catch that rebroadcast of Traders Nation, or check out that individual interview over at tradersnation.com or YouTube. Everything about that interview is very important for your financial future. You should listen to that whole interview once again, maybe twice again, Don, because that interview is just absolutely packed with information on what's going on right now and how to protect yourself, no doubt about that.